Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage Eitel.
All right. My name is Mark Eitel, host of the Mr. Mortgage Show. Dom, my producer, and I do this every week right here at the same time on this station. So thanks for joining us. And you are in the right place if you want to walk away from this hour with the information and the data that you need to make better real estate and mortgage decisions for you and your family. I mean, there's a lot of crazy news going around right now. Are we in a housing bubble? Are we in a recession? Is the recession going to pop the bubble? We're going to dig into all of that. We're going to dig into the headlines as well as I mentioned, get to all of your questions. So we are super excited that you're here with us. My name is Mark Eitel. I host the Mr. Mortgage Show each week. And we encourage your questions. Get those questions to us via the Anytime Hotline, 561-291-8569. That's 561-291-8569. And that is a good number from anywhere in the country. I don't care if you're listening to us. We've got some new partners and new listeners in Virginia, so we're super excited to have you as part of the Mr. Mortgage family. And you can call us on that number from anywhere, 561-291-8569. If you're shy like me and you don't want to get on the air, then Dom will just read your question for you. So shoot those to us, and then you can hit the website, www.mr.mortgage. You can submit your questions via email through the website, mr.mortgage, never a .com, just mr.mortgage. And then a cool new thing that we've done is we've built out a new Facebook page for the show. So if you're on Facebook and you search the Mr. Mortgage Show, you'll find us. And we're using that page kind of as a data dump, if you will. So all of the articles that you hear me reference and the data sets, we're posting those on the Facebook page so you can do your own deep dive. And we encourage your conversation there also. If you have comments or additional questions, especially during the week when you're not able to call directly into the show, use the Facebook page. There's a lot of good stuff there. So we're going to dive right into this week's show. We're going to start with just, a lot of news this week was talking about doom and gloom. The housing market is going to crash because interest rates are rising. And if you're a listener of this show, and I'm going to dive into it in this week's show, that's not the case. I'm going to give you the information you need to understand that this is a very different environment than a quote unquote housing bubble. We're definitely in a rapid appreciation cycle, but we're not. I don't see a teetering downswing anytime in the near future. That's dangerous or of serious concern. So anyway, we're going to cover that. Interest rates have kind of settled into a range, so not a lot of excitement there. Certainly have increased over the recent past, but we kind of fell into a trading range this week. So a little stabilization there. So hopefully we see that moving forward. But yeah, let's not waste any more time on what happened yesterday. Let's dig into your questions. I see, Dom, we've already got a couple teed up, so I'm going to throw it over to Dom and see what we've got.
All right. We have Cindy sent us an email. Cindy's asking, I just saw that the economy shrank 1.5% so far this year. What is that doing to the real estate market?
Hey, Cindy. Yeah, thanks for that. And I guess that's going to pull us right into the conversation and into some of the points that I touched on just a minute ago in opening. So, yes, you've heard us say this for months now, and I'm not patting myself on the back by any means, but I think we have an advantage in being in the business day-to-day operating a lending practice. We're actually boots on the ground, and we're seeing, real-time data. And by the time it makes the headlines, it's already happened. So yes, the first quarter, we saw it was actually 1.4% retraction. And this isn't new news. We've been saying it for a while. We are in a recession, and by definition, a recession is 2 quarters of negative GDP. So it would have already had to been in place for 6 months for them to announce that it's here. And I guess that's where we have an advantage. We're not waiting for the eye of the hurricane to come over your house to tell you the weather's bad outside. We've seen a slight shift moving into this, driven primarily by inflation. So yeah, you're right. The news is out. We've seen a shrinking economy in the first quarter. The good news is, and we've talked about it in length, and I'll post the data on the Facebook page, actually, now that I think about it, housing does relatively well historically through a recession. And on the other side of a recession, the Fed will typically loosen monetary policy and rates will come back down. Now, don't expect that to happen by Christmas. I don't think rates are coming down anytime soon. But what I mean by that is when you are in an overheated economy, the Fed, in an effort to slow it down, makes moves, or the economy is just running out of steam on its own, and it pulls back everything. Think about sitting on the beach and watching the tide come up. It doesn't just suddenly hit your feet with one wave. It comes up a little bit, down a little bit, up a little further, down a little less, up a little further on the next wave, down a little less until it reaches its peak. So that's what happens in any cycle. So we've been seeing this, this overheating economy for a bit of time now. So yeah, we're in a pullback phase. Again, good news is real estate does well in a recession, with the exception of the recession that was caused by the real estate bubble of the early 2000s. And we dissect that in length in a couple of videos on the Facebook page. So dive in there. So to answer your question, what do I think it's doing to real estate? I don't think it's doing anything to real estate. I've touched on this many, many times, and I encourage you to dig into supply and demand. And again, I don't want to oversell the Facebook page, but there's a great video on supply and demand. And I don't want to take this whole show off topic to supply and demand, but that's what governs prices or values, if you will. When there's less supply than demand, prices are going to go up. And right now, today, there's still overwhelming pressure on the demand side. Everybody wants to buy a property relatively to the number of people who want to sell a property. So right now, still a ton of demand. And let's face it, interest rates are still cheap. We're all hung up on yesterday. Hey, listen, I remember when I had a full head of hair and six-pack abs. It's awesome to remember those days, but they're not coming back. Maybe the six-pack abs if I wasn't putting off that getting back into the gym promise that I've made Mrs. Mortgage many, many times over the years. But nonetheless, the 2% and 3% interest rates are not going to come back. It's going to take another pandemic type of crisis worldwide for us ever to see that again. So don't look back. Look to the future. And looking forward, 5%, 6% interest rates are a great price for money. It's still cheap money. So don't look at the interest rates. Look at your budget. We talked about that too. If you can afford to buy for X amount of dollars a month and you can find a property that fits those needs, then make the move. So Cindy, to answer your question, I don't think there's an immediate negative impact on real estate. On the contrary, I think real estate's always been a great safe harbor in a recession. And as we move deeper into it, and hopefully it's a short and painless recession, but I think real estate is a great place to be. And lastly, I want to touch on this. I don't want to go too deep into this because I want everybody to go to the Facebook page and watch the video. But the number of U.S. households to the available number of properties for sale right now is greatly disproportionate. So in the early 2000s, we had more properties for sale than we do right now, and we had less. The number of U.S. households was smaller, so less people, more supply. Right now, we have less supply and more people. So another reason why I think we're safe for the near term future in housing. So happy to dig in on that if you ever want to have a conversation. Just hit us up 561-291-8569, and we'll be happy to have a discussion. So hey, Dom, do we have another question?
Yes, we do. We have another email, actually. This one's from Mateus. Mateus asking, I'm going through the immigration process, but I already have a DACA status. Can I get a mortgage?
Hey, Mateus, that's a great question. And hey, congratulations on going through the immigration process. And DACA is also often referred to as the Dreamers. And if you've been issued the DACA status, then yes, you can buy a property, even though technically the Dreamers are undocumented immigrants. If you're accepted into the program and you've received the status, then yes, you can buy a property with a variety of loan programs. And in the U.S. Immigration Bill of 2021, FHA expanded their guidelines to allow DACA recipients to receive an FHA loan too. So happy to dive into that with you, my man, and congratulations on 1, immigration, and 2, home ownership. So super exciting to hear that you're taking those steps. But on the other side of this break, we'll dig into more of your questions. 561-291-8569 is the Anytime hotline. 561-291-8569. Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
My wife and I own a small business. And the way our accountant file our taxes, we don't show much income on tax returns. Because of this, it looks as if we don't make the money. This was a problem for our bank when we applied for a mortgage. But not for Mark. He verifies our income by using our monthly bank statements. Mark and his Mr. Mortgage team made a big difference for me. Yes, I am happy to recommend Mr. Mortgage Mark.
It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at soflappraisal.com. That's soflappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. soflappraisal.com. And tell them you heard this on the Mr. Mortgage Show.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right. We are back. My name is Mark Eitel, host of the Mr. Mortgage Show, and you heard the man. Give us a shout at 561-291-8569. With any questions, that's 561-291-8569. If you're too shy to get on the air yourself, Dom will take the question and just read it on the air for you. Or you can always shoot a text to that number too, 561-291-8569, anytime hotline. Also, the website is www.mr.mortgage. That's mr.mortgage with no .com. So we are going to keep this train rolling. We're going to throw it back over to Dom for additional questions if we have any.
Yes, we do. We have Jeff that just called asking, I'm negotiating a lease option with my landlord. How long do I need to lease before I could get a regular mortgage to buy it?
Hey, Jeff, that's a really good question. There's a lot of moving parts to that. So I'm going to give you some very general answers, but I'm going to encourage you, if you have further questions, to give us a shout. And that number again is 561-291-8569. And keep in mind, everyone, you can use that number during the week too. If there's something that you want to dive deeper into, that number, yes, it rings into the studio right here while we're doing the show live, but it also pushes to my office during the week. So if you need to get me, somebody will get you in touch with me directly by calling that number, 561-291-8569. But to get to your question, Jeff, so here, I guess I have to push a question back to you. First of all, lease option is awesome. And I guess before I ask Jeff the question back, let me explain that in case somebody doesn't realize what it is. It's basically like rent to own, might be a more common term. So you negotiate a purchase price now for a future closing date, and you negotiate a monthly payment. Now, sometimes, and this is where I say there's a lot of moving parts to it, sometimes you'll make a rent payment, or in this case, a lease payment each month, and a portion of that payment will be applied to your down payment that will be used in the future. That's a very common practice. So let's use super round numbers for, to keep math simple, because I'm a simple Florida hillbilly, if you will. Let's say you're leasing for $2,000 a month, and let's start and say you negotiated a purchase price of $250. So you're leasing the property for, let's say, $2,200 a month, and $400 of that payment is going into an escrow account to be used for a future down payment. That means after the first year of that arrangement, you would have accumulated $4,800 in escrow to be used towards your down payment and your closing costs. So if the loan program that you are going to use to buy out the option requires a 3% down payment, and you negotiated, I already forgot what I said, $250,000 price. Let's just use that to keep it rolling. A $250,000. That means you would need to have accumulated $7,500 to be able to have enough money in escrow. Now, that doesn't mean you can't bring money from other sources. You can use gift funds, savings. I'm just saying, fundamentally, if that is your strategy, then in that instance, it would take you 2.5 years, 2 years and a few months to have. No, 2 years to have enough money to close on the transaction. So if that's your strategy, then make sure your purchase date is out far enough to allow you to accumulate that money in escrow. Now, if it's just a private individual that you've made this arrangement with, oftentimes they don't have the resources to escrow that money for you. So the more common lease option in that case will be just a future sales price and then a future closing date. So on or before 36 months, say you're able to buy the property for $250. Then it's up to you to save up your down payment and get mortgage ready. And oftentimes, those are the two reasons why somebody will lease option. I mean, there's more reasons. If you're uncertain that this is going to be your forever home, but you want to secure a price now, a lease option is not a bad idea. But if you need time to build your credit to be credit worthy, or you need that time to accumulate enough money for the down payment and closing costs, you want to do the math and make sure your option period is longer than the longer of those two cycles. I hope that makes sense. I'm happy to walk you through it. Give us a shout, 561-291-8569, and I can dig deeper with you on that. And my question to you was going to be, why are you lease optioning the property instead of just buying it now? And typically it's one of those two answers. You either need time to save up the down payment, in which you're going to want to use that calculation to determine, okay, I'm going to need X amount by this date, so I need to make sure I'm able to do that. So push that date out far enough to make that happen. And then the second side of that often is you need, some work on your credit score. You need, I don't know, maybe you need to wait until you get a better job, a raise, whatever that side of the equation is on the credit and income side that might deter you from buying now. Make sure your plan to get mortgage ready is a shorter window than that option period. So hopefully that makes sense. There's no mathematical cut and dry answer. It's not like a lease option term has to be exercised within 18 months for it to be a legal binding option. I've seen, options out 5 years. So anyway, hope that helps. I'm happy to spend some time with you because I think it requires a little more information for me to give you a really solid answer. And I welcome the opportunity to talk you through that. So I'm going to throw it back to Dom and see if we have anything else teed up.
We do. We have a text, and this one is anonymous. The person's asking, I really want to refinance and pull the cash out for a remodeling. I'm struggling with the idea of paying a higher rate. Is there a formula you use to see if this makes sense? Thanks.
Hey, that's a great question, Anonymous. And when Dom said that's anonymous, I think of that character that was floating around the internet with the big mustache and the cloaked head. So I'm going to speak to that Anonymous. So, hey, listen, that's a great question. And all kidding aside, we're getting a lot of that right now because, as I mentioned in the opening segment, with my 6-pack abs and my full head of hair being a thing of yesterday. So are, 2 and 3% interest rates. So the people that are considering a refinance right now, most oftentimes, unless you sat out on the sidelines through the refi boom of the last 2 years, you're going to be paying a higher interest rate than you currently have. So that's a struggle for a lot of people because it's hard to get your mind around spending more on the money that you've already borrowed. And it's an easy calculation when you're just determining how much money you're saving per month, which is like a debt consolidation or a rate and term refinance, where you're saying, okay, by doing this refinance, I'm saving, I don't know, throw round numbers out there. I'm saving $800, $1,000 a month. That's a round number. So it cost me, $10,000 in fees. So at 10 months, I break even. That's easy math to do. On the other side of this, where Anonymous, you're considering remodeling your property, you're borrowing more money than you currently owe. And assuming that you're not paying off debt, you're going to have a higher monthly payment. So to make sense of it in your mind, you have to look at the additional value that you're adding to your property and take that appreciation that you're forecasting. And again, don't use yesterday's appreciation because we're not going to appreciate double digits moving forward. Use a 6 or 8% appreciation rate, something that's conservative and comfortable, and say, okay, and again, I like round numbers for these type of conversations. I owe $300,000, but if I borrow another $150,000, my loan's going to be $450,000, and I'm going to put an addition on my house and a pool or whatever you can get for $150,000. I don't know. What will my finished product be worth? And then apply a reasonable appreciation forecast to that finished product. Are you turning your property into a $600,000 property? I don't know. These are questions you're going to have to ask yourself. And then at that point, say, okay, my $600,000 house is going to gain, 8% a year. Then I can see what that cost of money is actually earning me in appreciation equity. So hopefully that makes sense. And that's another one that may require some additional conversation that I'm happy to have with you. 561-291-8569 is the Anytime hotline. Dom and I are sitting in the studio right now, so that question will get on the air. But if you have that question during the week, call that number also, 561-291-8569. That's the Anytime hotline. We're here and happy to answer your questions. Or visit the website, www.mr.mortgage. That's mr.mortgage, no.com. Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
We started our loan with a different company. They said we were approved, but at the last minute they told us there was a problem. I still don't know what went wrong, but thankfully our real estate agent told us about Mark. I was pretty stressed, but it's the perfect house, so we gave Mark a shot. He got it done. I'm not sure what was different, but I don't really care. We even got a better interest rate and with less money out of pocket than the first guy quoted us. It was a great surprise. Yes, I'm happy to recommend Mark and his Mr. Mortgage team.
It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at soflappraisal.com. That's soflappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. soflappraisal.com. And tell him you heard this on the Mr. Mortgage Show.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, my name is Mark Eitel. I host the Mr. Mortgage Show every week right here, same time, same station. So thank you so much for being with us. Dom, my producer, and I are in the studio to answer all your mortgage and real estate questions. Actually, if you want to talk about music or motorcycles, throw those questions at me too. I'm happy to geek out on that stuff. So anyway, we're going to keep this thing rolling with your questions, and I'm going to throw it back to Dom and see what we have teed up.
All right, Shauna just sent us this email. She's asking, we'd like to buy some rental properties, but want to buy them in our company's name. Is it possible to get a mortgage in a company's name?
Hey, Shauna, that's a great question. And yes, so there are several loan programs out there designed for investors. And typically, you'll put your property in an LLC, and we can close in the name of the LLC. In the name of a corporation, there may be some challenges if the corporation is encumbered in other areas. But it's certainly doable. Yeah. So to answer your question, that was an easy one. Yes, you can close in your company's name. If you have questions around that, I encourage you to hit us up during the week, and I'll walk you through how to do that, and then what loan programs are available specific to investment property in the name of a company. So yeah, let's keep it going. Dom, what do we have?
All right, Walter just called the hotline. Walter was asking, what is the minimum age required for a reverse mortgage? My wife is quite a bit younger than I am. Do we both need to meet this requirement?
Hey, Walter, that's a great question. And I don't know if you just called that in because you're bragging, because you've got the young wife. Well done, sir. Well done. But no, I'm kidding. Anyway, to answer your question, 62 years old is the typical reverse mortgage or HECM loan program minimum age. Here's something that's super exciting, though, for guys like Walt who have a younger wife, or vice versa. If Walt was the young one in the relationship, there's a what's called an eligible non-borrowing spouse rule that allows your under 62 aged spouse the same protections that you have with the reverse mortgage. So this brings to memory a client that we're currently working with. We just about have it wrapped up, and they are super, super amazing people. When we're finished with it, if I have their permission, I'm going to shout them out on the show because they've just been amazing to work with. But he is in his mid 70s, if memory serves me, and she is not yet 62. So they were super concerned that taking this reverse mortgage was not going to be an option until she was 62. And we use the eligible non-borrowing spouse rule, which allows her to remain in the property until her death with no mortgage obligation either. So, the assumption is he's going to go first because there is quite an age gap. And she gets the full protections extended to her. So it's a great addition to the program, because rather than them, as traditionally they'd have to wait, using this ineligible non-borrowing spouse rule, they're able to go ahead and execute the reverse mortgage now. They're going to get a payment at closing. They're going to have a credit line available to them that they can use for the rest of their life. Assuming they don't use it all, but it's going to be available to them indefinitely. And then she gets to stay in the property until her death. And then all those same rules and nuances that we talk about often apply to her, even after he's gone. It's her property, and she has no obligation to move, sell, or satisfy the loan until her death. So, Walter, to answer your question, she does not have to be 62 yet, assuming you are. She may qualify for what we call the eligible non-borrowing spouse, but that one certainly requires some more discussion. So give us a shout, 561-291-8569 during the week, and we'll be happy to dive deeper with you on that. And one other cool thing that applies to some of the higher net worth properties is you can go down as low as 55 years old with some of the reverse mortgage products. It's not a traditional reverse mortgage product, so there are some nuances and a lot more questions that need to be answered. But this doesn't apply to Walter's question, but I just wanted to throw that out there because a lot of people are unaware of that being available to them also. So, Walt, for you and your young trophy wife, She does not have to be 62 as long as you are, and hope that helps. Any other questions you have on that, I encourage you to reach out via the Anytime Hotline, 561-291-8569, or visit us online at www.mr.mortgage. So you guys can't see this, but I'm throwing the ball back across the board to Dom, my producer, for another question.
All right, Rhonda just shot us a text. Rhonda's asking, I know we missed the super low rates, but my husband and I are ready to still buy. If rates go back down, how soon can we refinance after rebuy?
Hey, that's a great question, Rhonda. And first, let me congratulate you on not getting hung up on the headlines and still moving forward, because as you know, I'm passionate about real estate still making sense for many, many reasons. But anyway, congrats on that. So to answer your question, on the outside, 6-7 months, I think it's 7 payments, I think some programs require, but most don't have a waiting period. Now, if you're going to use an FHA loan and you're going to flip to an FHA Streamline or what's called an IRRRL with a VA loan, it's a straight interest rate reduction. There's a period with FHA. It's, I think, 210 days, 215 or 210. I'm doing this from memory, but in that instance, you're talking less than a year. And the reality is rates are not going to dip down within that time period. So by the time rates move for you to make it make sense, you should be in the clear. But again, happy to dive deeper if you have additional questions. And you know what? I'll research the exact number on the different loan programs and post that to the Facebook page so everybody has it. Just hit Facebook, and up in the upper left-hand corner of the Facebook page, you'll see a little search bar. If you type in The Mr. Mortgage Show, you'll find the Facebook page, and there there'll be a lot more data supporting my answers, but I'll specifically post things to the timelines for refi if that helps. So hopefully that gets you started. If you have more questions, I encourage you to reach out. But let's keep it rolling. What else do we have, Dom?
All right, Steve wants to know, my father just passed and has left everything to me and my 4 brothers. I want to buy my dad's house. Is this possible?
Wow. If I heard Dom right, Steve, you grew up with 4 brothers. I bet you guys were the bad boys on the block. I grew up in a neighborhood, and there was one kid who was from a group of 5 brothers. And when he stomped off the basketball court and said, "You guys are in trouble, I'm going home to get my brother," we all left because he wasn't coming back with just one, and they were some tough kids. So anyway, you just brought back a memory for me, Steve. But hey, first of all, my condolences on your dad's passing. Yes, this is certainly doable. There's a few things to consider with this, but I'm going to use the assumption that okay, just made some notes. There's 5 of you total. So I don't know what else the estate has, so I can't speak to this in great detail, but let's just break it down to the house. And you are 1/5, assuming all the kids are equal heirs, you own 1/5 of that property as far as the estate's concerned. So you already have 20% equity in the property. So this should be a fairly easy transaction for you to take an 80% loan against that property, and you're essentially buying it using your equity position in the estate as the down payment. So to answer your question, yes, certainly doable. There's a lot more that I would need to know, because sometimes there's other assets in the estate, and if you're the only one that wants the house and your other brothers want to split the other assets and take your portion of that, you may be able to walk with the house free and clear, or a much lower loan amount. But that's something to speak to the probate attorney about. We do this all the time. We're in the middle of 2 of these transactions right now, where an heir is basically refinancing a property that they inherited from the estate. So certainly doable. I would need a little more information, and I'm happy to walk you through it. So I encourage you to hit us up during the week at 561-291-8569. Oh, I hear the sirens coming up behind me, so that means we're going to step into another break. We'll be back in 2 minutes to take more of your questions. Those questions, shoot them to us at 561-291-8569. That's 561-291-8569. or visit us online at www.mr.mortgage. That's mr.mortgage with no .com. Never type in the .com, just mr.mortgage. We'll be right back in 2 minutes. Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
We kept our business above water with credit cards during the pandemic. I'm glad we did. Business is better than ever. But I didn't want to be a slave to those credit card payments. I called Mark about the rec loan he advertises. Long story short, we did a rec refinance and paid off everything, even the car. Now we only have the mortgage payment. We're saving a bunch every month. Yes, we are happy to recommend Mark and the Mr. Mortgage team.
It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at soflappraisal.com. That's soflappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. soflappraisal.com. And tell them you heard this on the Mr. Mortgage Show.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, we are back. My name is Mark Eitel, host of the Mr. Mortgage Show. And yes, shoot us your questions to 561-291-8569. You can call or text that number, so don't be shy. Just fire away with your questions. And you can hit us on the website at www.mr.mortgage. That's Mr.Mortgage. Or if you want a deeper dive into the world of Mr. Mortgage and the shenanigans that go on during the week, visit the Facebook page, The Mr. Mortgage Show. You'll find us there on Facebook. So we're going to keep rolling with your questions. I know Dom just gave me the signal that we have another one teed up.
Yes, Claudia just emailed us. She's asking, I may be crazy, but I thought I remembered you talking about when I could show my car is paid by my company and not me to help my chances.
Hey, that's a great question. So, yeah, here's the story with that. And we did talk about that. If you own your vehicle, which is not uncommon in your name, but your company, most small business owners do this, will pay the car payment, especially if you're using it for your business, out of the business account. So technically that's a business expense, but when we are underwriting you for a mortgage, it shows up on your credit report. So if the company is paying for your car, in order for us to pull that out of your debt to income ratio, which is what I believe you're talking about, the company will have needed to pay that and will need to document it for 12 months. So that the same goes if you co-signed a car for your sister, your brother, your child, your nephew. He's or she is going to have made that payment for 12 months. So in your case, the company, we're going to look at the company making the payment for the previous 12 months, document that, and then we can pull that out of your debt to income ratio. Here's one caveat that everybody misses. It's super frustrating. I talk about this all the time with industry friends. It makes no sense. As soon as you buy a new vehicle, that 12-month period starts over. So if you're leasing a vehicle for your business and you turn it in and you lease another one, that 12-month clock starts when the new debt is acquired. So if you can buy it in your company name, it makes it easier. But if you buy it in your name, just know that it's going to be 12 months from the day you bought that particular vehicle. And sadly, it doesn't matter if you've been doing it that way for 20 years. And can show 20 years of history. that clock resets with the new debt. So hopefully that answers your question. 12 months documentable, someone else making the payment, in this instance, your company, then we can pull it out of your personal debt to income ratio when qualifying you. So hopefully that helps. If you need more info about that, you know how to get us. So I'm going to throw it back to Dom.
All right, we have Roland just called with this one. He says his agent said his condo is not warranted, so it's going to be harder to sell. Can't the buyer get a home warranty on a used home? He thinks he's misunderstanding something. Any thoughts?
Hey, Roland. So, yeah, I do think you're misunderstanding what, and I might be wrong, but what I believe your agent is meaning by what he or she is telling you is that the condo is non-warrantable, not that it doesn't have a warranty. And what warrantable versus non-warrantable basically means is whether the property is eligible to be financed by a conventional loan. And a conventional loan allows for the smallest down payment and often the most favorable interest rates, with the exception of a government loan. Sometimes a condo is eligible for an FHA loan, so it may apply in those instances too. But to answer your question, I think what you're referring to is non-warrantable. And what that means is it doesn't meet the requirements of Fannie and Freddie for a conventional loan product. And what the warrantable versus non-warrantable covers, and this is something I guess every condo owner really should know, is they're looking at things like the number of units that are owner-occupied or second homes in your complex. So they don't want a bunch of rental properties. And we saw this happen in the local area after the bubble burst in the early 2000s. We saw people going in and buying a significant number of units in a building that had gone into foreclosure, and they were putting recovery centers in the building, for lack of a better word. And they might have 15 units in this condo building that they opened up as treatment centers. And now it was very difficult for people to buy and sell within that building, because nothing against anyone going through treatment. I commend you on taking that step to get clean, but it's not the most desirable circumstance to live next door to. So in those instances, there were a large percentage of the building that was owned by, in this instance, a treatment center, or it doesn't matter. It could just be an owner that rents them all out. If the number of the units exceeds the guideline, then it's not warrantable. If there's a large number of units with delinquent dues, that will make it non-warrantable. They want to make sure that the association is healthy and they're collecting dues and they're maintaining the building. Hey, we saw what happened in the Surfside collapse, which I believe has almost been a year at the date of this show. So maintaining a building is super important. So if there's delinquent dues, there's not money for maintenance. So that's something that's looked at when a building is being classed as warrantable or non-warrantable. And then another big thing that we see with the older buildings is not enough of the dues are going for reserves, because we all know that even doing our best, if we're trying to forecast the expense of a new roof in 20 years, we don't know what that roof's going to cost. So there's a calculation, and it's often 10%. They want the Fannie and Freddie want 10% of the dues collected to go into escrow accounts for future expenditures for maintenance. So those are a lot of things that go into the evaluation of a condo to see if it's warrantable or non-warrantable. And that may be what he or she is speaking to, is that it's not warrantable for whatever, a litany of reasons. And in that, if that's the case, then it may be more difficult to sell, because to buy a non-warrantable condo, you need to put a larger down payment down and pay a higher interest rate. There are lenders out there that'll take the risk, but they're typically going to look for a 25% down payment. And then the interest rate associated with a non-warrantable purchase is going to be most often higher than a conventional loan product. So I hope that answers the question. I think what they're referring to is warrantable or non-warrantable. And the way to determine that is to go through the full condo questionnaire procedure to make sure that maybe he or she is wrong and your building is warrantable. But I think that's what she's speaking to. And I'm happy to answer any additional questions that you have regarding that, because it's a big topic right now. Post the Surfside building collapse, there has been, what was that called? The Champlain Towers in Surfside, Miami. There's been kind of a reboot of the condo questionnaire in general, and they're asking more specific questions to maintenance, to budgets, to deferred maintenance primarily. And if the association refuses to answer the question, they're even auditing the minutes of the previous meetings to see if there's any reference in those minutes of deferred maintenance, because they're taking this very seriously. So I'm guessing she's talking about warrantable versus non-warrantable, but I don't know. If you have more questions regarding that, give me a shout. I'll be happy to dissect that for you, because it can be kind of tricky. But yeah, I think she's speaking of non-warrantable. And to answer the other half of your question, some people would say, hey, can't you just buy a home warranty? You can actually get a home warranty on a condo. So if she's talking about the fact that, or he, I keep saying she, but that's because most of the rock star realtors I know are she. If your agent is speaking to the fact that there's no warranty, and I don't know why that would be an issue, but if that's genuinely the case, that it's warranty and not warrantable, you can get a home warranty on an existing home or condo. And as a seller, you can buy that for the buyer. A buyer can buy it for themselves, and it will provide warranty coverage on all of the, major components of the property. So if that was the question, then yeah, just grab a home warranty. But I'm thinking it was most likely warrantable versus non-warrantable. But anyway, I know that was a lot of technical stuff. So if there's more information needed on that, just give me a shout. 561-291-8569. We will be back in 2 minutes to take more of your questions and give you the info that you need to make better real estate and mortgage decisions for you and your family. We'll be right back. Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
As a realtor, I have a bunch of mortgage brokers to choose from, but I prefer to work with Mark and his Mr. Mortgage team. In this crazy market, there is no room for error, especially on the mortgage side. Mark's team moves fast, keeps everybody in the loop, and makes things happen. They always give my clients a great deal and take the time to walk them through every step of the process. When you're considering a lender, I encourage you to talk to Mark Eitel and the Mr. Mortgage team.
It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at soflappraisal.com. That's soflappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. soflappraisal.com. And tell them you heard this on the Mr. Mortgage Show.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, we are back. My name is Mark Eitel. This is the Mr. Mortgage Show, and we do this every week right here, same time, same station. So thank you so much for joining us. And during that break, Roland was kind enough to shout back at us and said it was the issue of warrantable versus non-warrantable. So hopefully we cleared that up for anybody that had a question surrounding that. So Dom just handed me the questions we covered so far, and I just want to take a second to kind of summarize a few things. So the very first question out of the box, Cindy hit us right between the eyes with the big question of the day. And that's kind of, the market's contracting, the economy's contracting. It looks like we're in a recession. What's that going to do to housing? And I talk about this all the time. I hope that I give you some good data points surrounding this, and I encourage you to hit the Facebook page to dig in deeper, because I'm sharing a bunch of stuff, the things that I read to kind of encourage me and help me kind of dissect where we are with all of this, because I'm not a headline guy. I mean, by the time it makes the headlines, they're trying to do one of two things. They're either trying to get ratings, or they're telling you about something that's already happened. And I don't think you future cast your way to success by navigating, by looking out the rear view mirror, if you will. So I wanted to share this because you heard me talk about it in the past, and this speaks right to Cindy's question. I just happen to have these notes in front of me. I dove into this a little bit last week. I talked about the differences in this market versus the early 2000s. And if you've seen my belly or my hairline, you know that I was around back then. So I talked many, many times in the recent month or so regarding what was different back then. People were borrowing with higher LTV, adjustable rate, interest-only loans. And I found this statistic this morning, actually, which I found super, super interesting. And it's a chart, and I'll post this in the Facebook page. And it basically shows the loan to value. We call it LTV. You'll hear that used often in real estate. The LTV, meaning the amount of debt against a piece of property relative to its value. So that's the ratio that they're talking about. And I'm going to post this because I want everybody to see it in black and white. If you look at the chart, and I'm holding it up for Dom, even though he's from his distance. I don't know. He's got young eyes. He can probably see it. But if you look at the historical chart, it's very flat. We didn't have an increased LTV. But if you look at the bubble period, people were borrowing significantly more against their property. So the LTV line on this graph shoots way up. And then if you look at where we are now, today, it's lower than where we were in the 50s and 60s. Now, a lot of that has to do with the home value shooting up so quickly, and a lot of people not moving, so they're sitting on a ton of equity, so their LTV is arguably low because of what's gone on around them. But people are still putting bigger down payments down now than ever before, and a lot more people are buying with cash than ever before. And you've heard me speak to that too. Without an adjustable rate mortgage to change your monthly payment, it's much easier for somebody to stabilize their monthly debt outflow and weather a recession. So can you imagine going through a recession and having your mortgage payment jump by double or triple? Well, that's what happened in the early 2000s. That's not what's happening now. And there's no indication that it's going to happen in the future because the vast majority of people have a ton of equity and they're so very well underwritten. So throwing it all the way back to last week and the weeks before, watch supply and demand. Right now, there's more demand than supply, and there's no reason why people who are currently in their homes can't stay in their home as long as they have a job. So watch unemployment. If unemployment ticks up significantly, then there might be some pressure. But right now, this past week, the unemployment numbers was 5,000 less than the week before for new unemployment claims. So certainly stable, most likely continuing to go down. So you see the help wanted signs everywhere. We talk about, there are more jobs than people. So as long as people have a job, they own their primary home, they have equity, they have a fixed monthly payment, there's really no fear that they're going to lose that property. So I throw that out there just to, exhale, rest assured that we're in, at the moment, still a healthy, frothy, but healthy housing environment. So, hey, I hear the sirens. That means they're going to take me away. We look forward to joining you again next week. Same bat time, same bat channel. Until then, you can find us on Facebook at The Mr. Mortgage Show or hit the website www.mr.mortgage. That's mr.mortgage. Thanks.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.